Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Thursday, the 10th of August. I'm Daniel Lam, your host for the podcast. On Monday, I participated in a speed chess tournament where each side had roughly 5 minutes for the entire game. This tournament was part of my preparation for the Asian Games at the end of September. Amazingly enough, I made exactly the same mistake in an identical position as I did on an internet game a week back, and I lost my first round game to a nobody. After that, I won 8 games in a row and became champion of the tournament, but it was already a scary experience. Now, I'm sure you all experienced volatility before in your portfolio. And wouldn't it be great if you have some assets that could potentially do well when there is shakiness in the markets? Well, we spoke about gold last week. We highlighted how it can be an effective diversifier in your portfolio if a recession were to occur in the US, which is our base case. Now, if there were to be a no-landing scenario, gold may still perform well if inflation were to stay elevated or to surge again. Now, the World Gold Council has released its gold demand trends for the second quarter of the year. Well, demand softened Q-on-Q, led by lower central bank net purchases and jewelry demand stagnating amid higher prices. Total demand was the weakest since the first quarter of 2021. Official sector demand made up 11% of global demand in the second quarter of this year, in line with the average of 12% since 2010. However, in comparison, in the third quarter last year, this figure was 38%. Now, notably, in the second quarter of the year, unreported buying offset net selling, as reported by IMF statistics. Now, the World Gold Council noted that the first half of 2023, there were net additions of 387 tons. That marked the strongest first half on record. Without the central bank buying, the floor for gold would likely to be lower. So the key question here is whether central bank demand may continue. Well, we believe it should continue because gold as part of central bank reserves have doubled since 2015. But US dollar reserves is still dominant at 60%. And of course, de-dollarization, which is a consequence of multi-polarization in the world, we believe that is likely to be a multi-decade trend. Now we have a 12-month forecast of gold at 2050. We expect further moderation of real yields and the US dollar over a 6 to 12-month horizon to boost gold prices as the Fed ends its hiking cycle and cuts rates as the economy slows. So technically, it seems reasonable to accumulate some gold between the support level at 1900 and 1950. The year high at 2072 appears to be a key level of resistance. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.